Market stocks enter August riding a high from July, but will it continue? Join us now, Jeremy Siegel, professor of finance at UPenn's Wharton School of Business. What do you think, Jeremy? July was a good snap back, but do you think we're headed for new lows at some point, or have we already made a real bottom?
Well, good morning, Joe. About an hour ago, you mentioned how important the employment report that we're going to be getting on Friday. And one of the things that really has puzzled me is that over the last 6 months, first half of this year, we added 2.7 million jobs. How did we get a drop in GDP? I don't know. People aren't asking that question. I mean, what are people doing? I mean, you get GDP by people working. 2.7 million jobs. I mean, the only explanation would be a tremendous drop in hours. Well, the official drop in hours doesn't explain it. Or a dramatic drop in productivity. Now, the first quarter, we had the worst productivity in 75 years, but it bounced back 75 years ago. Now the government is telling us with recent data that the second quarter, we're going to get a couple weeks, is almost as bad as the first quarter. This is unprecedented. We have never seen a collapse of productivity like that in history. I think, I was interested. What does the Biden administration say about it? What does the Fed say about it? Now, what the possible good news is, if we get a bounce back to that really slows down inflation, because obviously less productivity means more inflation, higher productivity, less inflation. I think the Fed should be near the end of its tightening cycle. I think we're already in a above neutral mode. I know a lot of people think not. Larry Summers has been arguing we're not there yet. Well, I think the neutral rate is somewhere between 1 and 1.5. We're over 2 right now. I think the Fed has got to be looking at the sensitive commodities and housing prices and say, you know what? Yeah, we messed up later on and caused a lot of inflation. Looking inflation has really been stopped.
So you don't think that the risk is that there's some type of stop and start scenario from which got us in a lot of trouble in the 70s? You don't do you think the Fed should settle on a terminal rate and not be data dependent? Or do you think that the first time it looks like they're having some success, they back off?
Well, they got to be data dependent, but they can't look at the CPI. We talked about the fact that that's really backward looking. And we talked about the fact that it understates the housing prices, which, the past CPI over the year, I think went up 10 to 12%. If they put in housing prices properly. But all the word from, housing experts and the data says, hey, that housing inflation. So if they look at the forward-looking data, and that's what the market wants. I mean, I think it went up last week because they said, I think we see a pivot there. I think we see Powell saying it's softening. We see the softening. We don't want them to say, I got to wait till the official statistics get down to 2% before I stop tightening. That would be disaster. So, I think that market is saying, hey, take a look at what's going forward. Yeah, there's a lot of inflation that has been in the pipeline coming through the official statistics, but forward-looking inflation, I think, is really nil on a real basis. And I think the Fed should really slow down the rate of hiking. And if we get a snapback in productivity, that'll put further downward pressure. I'm not going to guarantee we saw the bottom a couple months ago. It's impossible to sell, but earnings have really held up over even half the S&P companies have reported. Not as big a beat as last year, of course, but that was an all-time record. And guidance, yeah, a little bit lower. But I looked at the S&P estimate for just this year, so I'm not talking about 2023. It's not any different from January. Really, even with all that's happened. and a negative GDP read over the last 6 quarters, which how do we understand why that is happening when we hire 2.7 million workers? You know, you have to try to figure some of this data out before you make rash moves on the monetary front.
Let me ask you, Jimmy, what should we hope for on Friday? Is it nice to see the job market hold up, or does that just make the Fed more strident?
You know, the expectation is about 250,000, slower than the first half. I mean, I'd like to see the growth. We want, again, I'm wondering, well, we added 2 points, we had 400,000 a month on average. That's a 2.7 million, and all of a sudden GDP goes down in the first half. I've never seen that. And I look in the past data since World War II. So we're talking about 75. Nothing like that has ever happened. I think we have to say, just a minute, what has happened here? How can we have a robust increase in employment and a decline in GDP? And what does that mean for the future? And I think if Powell and others start talking about that, we'll get a clear look at what's going on in the economy and what that means for monetary policy. But that's the puzzle to me right now, is what's going on there.
Well, maybe it's lagging. That's what some people think, that jobs always lag, and there's definitely some slowdown apparent.
Yeah, well, people are twiddling their thumbs, not working. I mean, they say they're working 8 hours at home. Maybe they're working 4 hours at home. So we don't have as many hours that are actually worked as the government thinks. I mean, there's a lot of puzzles out there. I would not just look at past inflation data and say, oh my goodness, we have to keep on hiking.
Oh, okay. All right. There you got that side of it. A lot of people think they need to stick to it. But,
keep going.
Yeah. All right. Thanks, Jeremy.
Coming up,
Professor.
Jim Cramer's first take on the trading day ahead. We'll see whether he agrees. I think he does, but maybe not. Much more on today's biggest movers. Here's a look at the biggest pre-market winners and losers in the S&P 500. Squawk coming right back after this.